What's up, everybody? Jake Blickenstaff coming back at you in another video with the Northeast Georgia Real Estate Podcast. And as you can see, I'm joined with some phenomenal guests today. We got Evan Nissley with PrimeLending and Ryan Liebowitz.
What's going on?
With PrimeLending as well. So today it's going to be kind of a follow-up with, or a continuation, if you will, from what we did back in August. Evan and I like to do these at least twice a year. It really helps not only paint the picture of what's going on in the market, with the economic markets, with the real estate markets, with the rate markets, but it also gives us an opportunity to see how good our crystal ball is with what's going on in the economy, where people think things are going or heading, what we're seeing with the real estate statistics, and really just to kind of help paint the picture, because I mean, we can absolutely get lost in the weeds. I mean, you guys do this every day, and I'm sure it's like, we can speak the language, but to the neophyte or the non-financial person or the non-real estate person, I'm sure it's just like, what the hell did you just say to me?
Right.
So other than that, I'll let you guys jump in on kind of what your opinions are of like kind of where we're at now.
Well, before we get to that, we'll start and kind of go back to what happened since our last meeting back in August. And at that time, we were talking about the Jackson Hole Symposium, and it was a big meeting the Fed does every year. And obviously, in our world, we stay optimistic with this stuff, and there's reason for that, But at the end of the day, we don't have a crystal ball. We don't know what's going to happen. But shortly after that meeting, we got thrown into a pretty big curveball of, hey, we're not done with this whole mortgage rate increase. The Fed may not have done much since then, but mortgage rates at the time, if I remember right, in August were probably sitting somewhere in the sevens, probably the low sevens or so. We saw rates go up into the eights late last year, fourth quarter, and that took everybody for a spin. The 10-year Treasury got to 5%. There was a time where we were worried that it may clip a very important line that from there, it hadn't gotten there before in 20 years. Had it gone over that, it was in no man's territory. So we didn't know what was going to happen. But fortunately, that didn't happen. We started to see the data cool, late last year. We started to see job numbers get a little weaker, started to see inflation numbers get a little better. And then we had a really strong, Fed meeting, I guess in December, that kind of kicked off a slew of, mortgage rates decreasing. And we've seen a nice little decrease over the past month and a half.
So Ryan, what are you seeing on your side from, like, say, over the last 6 months, from like where we previously were to kind of where we're at now?
Sure. Similar to Evan, I mean, October was crazy. What rates got up to in October, and then all of a sudden, November and December, we saw, the MBS down by 125 basis points, which is phenomenal. But as lenders, we're trying to figure out, well, what's going on? Right? What is the data that they're looking at, the Feds are looking at, in order for us to tell you, hey, listen, here's what we think the outcome is going to be over the next month, 3 months. And with the Fed president, sometimes they're saying things a little bit differently. You may have an Atlanta Fed president saying one thing, the Boston or New York Fed president saying something else. So when those things happen, man, the markets can move pretty dramatically. So over the last probably 45 days, we've seen similar discussion points from most of the Fed presidents. So that's why I think we've seen this decrease in rates, this pullback that we've hoped would happen for a year and a half.
Yeah.
We are seeing a little bit more.
Right. And, we got to the point late last year where Wall Street basically was calling the Fed's bluff. They were saying, hey, y'all are done. Even though y'all haven't said it, y'all haven't came out and said anything about it, we know you're done. You can see that in the Fed futures. That's really kind of, and the Fed looks at that. So if the Fed futures shows that the market's pricing in a rate increase, then the Fed's going to increase rates because they know the market's already priced that anticipating that. Yeah. And we saw the futures, basically was just like, hey, we know you're done. And I'm sure these guys, they do this every day. Us knowing the market, what's going to happen with rates, the prediction of that's only a sliver of what we do, right? We are here to serve our clients to get the best possible mortgage that we can get for them and make the best process that we can. So that's, it's a fraction of what we see, but they do this every day. So obviously there's stuff behind the scenes that we didn't see, but we'll take it. We'll take it.
Absolutely. And when we were talking back in August, some of the things that we were paying attention to is like the big saying, and I absolutely hate this from my side of the table, is like marry the house and date the rate, because you always have the ability to refinance down the road. And depending on the type of season, like what's going on with rates is really depends on like what you guys are busy doing. So like in a low interest rate market like we saw a couple of years ago, everybody and their brother was refinancing. And so now that's not probably as prevalent, because if you have a 4% mortgage and we're in like what's today, like a 6.5-ish, around that range would be a good guess. So like more than likely it doesn't make sense for you to do a refi there.
But
you guys might have a
depends.
Jump in there. Yeah, if you have anything to the contrary.
I mean, I think when you think about credit card debt going over, $1 trillion, like there may be really good chances for refinance. It's not going to be for everybody, but I was looking at a deal for a close friend that a refinance would actually put about $1,300 more in cash flow in their pocket per month. That's a big deal. I mean, when we're thinking about just the price of everything right now, if I was to give you an extra $1,300, we're going to use the equity that you've built up over time within your house to pay off some, unsecured debt and things like that. It's something to look at. Mm-hmm. Maybe it's not for everybody, but it is definitely something to look at in this time.
Well, and I know it's cheesy, the marry the house, date the rate saying, but that has been good advice to this point, because if you look at the Case-Shiller, which is the gold standard for price appreciation or depreciation, it tracks house prices across the nation, we're at a 4.8% appreciation rate for all of 2023. That should tell everyone something, that in an environment where rates are in the sevens, inflation's high, affordability is at all-time lows, yet housing prices are still increasing. And now we're in an environment where the likelihood is that rates are going to decrease over the course of 2024. The Feds came out and said, hey, we're expecting to cut rates. The 10-year Treasury is down a point. Mortgage rates have a lot of room to run downward still. So, now is a great time. We're in a season of the market where it's normally kind of slow. This time of the year where things are starting to pick back up, we get into our spring market. Marry the house, date the rate. Hey, you take a rate at 6.5, and you don't have to fight for it. If you refinance in November, December of this year down to 5.5 or 5, and you've got tons of competition at those rates, who's sitting prettier?
Yeah, absolutely.
And I think there's two different factors that we don't talk about a lot, is the appreciation in the value of your house.
Sure.
Right? If you're going to buy a house today, let's take your basic 5% appreciation over a year. Well, a $400,000 house, that's another $20,000 that you're going to pay for the price of your house. Like, it's just the value of your house. So what does a $20,000 difference make when we're talking about 6.5% even versus 5%? It's not huge, right?
Yeah.
It is similar. So keep it in mind that there are two factors working here. It's not just the rate.
Sure.
That is beneficial and helpful for you as a buyer.
Yeah.
And I know from the real estate perspective, one of the things that we've been advising like our clients and my team and pretty much anybody that I talk to is like, you need to realize as rates continue to drop, as they're projected to do over the next year, think about how many people are on the sidelines right now saying, I'm not going to do anything until X, Y, or Z happens. And so if you fill in the blank with when rates come down, then how many people are now jumping off of the fence to get back into the market? And then, so in my opinion, it's going to be very similar to, maybe not as bad, of like 21 and 22, where you have 20 offers per property, multiple bids above list price, and then you have to worry about appraisal gap contingencies and all sorts of different other wonderful factors that we dealt with during that time period. So while, yeah, the marry the house, date the rate, it is corny, but it is applicable 100% certainty, especially when you're looking at the competition that's also going to be in the market if you're fast forwarding 6 months from now. Because from the real estate statistics side of things for us, like our season starts February 1. That is when all of the activity, the days on market starts trending down, showings start increasing. So, I mean, everybody's getting out of the holiday season, taking all the Christmas lights down, whatever it is, in January, and then like boom, February 1, we're off to the races.
Yeah. Well, we're kind of starting to see that now a little bit. We were busy between Christmas and New Year's, and normally that's just a dead time. But new construction's been big. We've seen a lot of folks that are going after new construction, and that's just it's going to be a challenge for, I think, speaking into your expertise, but I feel like the challenge this year for real estate is going to be inventory, just like it was last year.
Yeah.
So, take it when you can get it. If you're looking to buy a home this year and, you can afford to buy a home this year, then, now's a good time to do it. Like you said, 5-year, 5% appreciation rate year over year. If it held true last year, I don't know why it wouldn't hold true this year and therefore after.
And let me ask you this, Jake, when it comes to seller concessions, like when we get into a market that, let's say we drop a point, we're in the 5.5 range, what type of how much will seller incentives reduce in that market versus a market like, let's say today, where you're seeing a pretty decent amount of sellers that are willing to move a little bit on price or willing to pay a little bit in closing costs? Tell me about that.
I'd say that would be pretty significant, because if I primarily work with sellers, and so from that side of the table, if I have a client and we have a property that's on the market, and let's just say we do receive 10 or 15 offers, the way that I will normally advise that client is, hey, let's look at, first off, are there any cash offers on the table? Because usually that means that there's no contingencies or anything like that. And in a tough market, sometimes cash offers are king, because they're going to be at the very top of the price point. It's not like back 5-10 years ago where you could come to the table with $20,000 less than list price and be all cash and it'd be attractive. Like that's not the case anymore. Mm-hmm. So we're looking at all cash offers first. Mm-hmm. Then we're looking at who has the least amount of contingencies in there. So like, do they have to sell their house, or can they just buy this without having to worry about that? Because what we're doing is we're trying to remove any potential obstacles that prevent us from getting to the closing table. And then next we're going to look at, okay, so who's asking for closing costs? Who's asking for repairs or anything like that? So like there's an order of the way that we look at things. And I normally try to also advise my client, let's not necessarily be too picky when it comes to the type of loan that it is, mm-hmm. because at the end of the day, the money's the money. Now there are going to be some different requirements that different loan types have.
Sure.
So like a conventional, it would probably be better than like a VA or an FHA, just because they're not as strict when it comes to certain things, but it doesn't mean that that's not just as good of money.
Sure.
So that's normally the way that I would advise my clients. But if you guys have anything else that you want to add into that, I'd love to hear it as well.
No, I think that was really good. And that's the thing today is, we write FHA loans and VA loans and conventional loans all the same as far as the process, the way we get things done. On the property side, it can be a little bit different. But, everybody has a short memory in this stuff, and we talk about the bad thing or the challenges that we face in any given market. Right now, it's affordability, it's buyers, it's price. In 20 and 21, it was, I can't go FHA. I have to go conventional because no one's going to take an FHA offer.
Correct.
So, that's one of those things that we don't necessarily have to deal with. And as a buyer, especially a lot of first-time home buyers, they're going to be going with FHA financing. They don't run into those challenges these days. They can get offers accepted with FHA financing pretty easily.
Mm-hmm. And then to your point also, Ryan, as we start to see more offers come in per property, that's when a lot of the times that anybody that is previously looking at when it was not necessarily a neutral market, but not at the peak of a seller's market, where it was like, hey, I can come in at list, but I can also ask for $15,000 back in concessions.
Right.
Sure. Like those days are going to be gone as soon as we start seeing multiple offers per property, because you will 100% not be the most appealing offer at the table.
Sure.
And so at that point in time, if I'm representing a buyer, for one, I'm going to be asking the question of like, will you be able to sleep if you don't get this house? Like,
I love that.
So if you can't, and like you absolutely are in love with this house and we have to get it, we have to come guns a-blazing with absolutely everything that we have within your financial means. Now, I'm not saying, hey, you need to bet the farm and this is going to put you strapped every month. But if like you will absolutely not be able to live with yourself if you don't get this picture perfect house, then hey, let's throw everything but the kitchen sink at it.
Yeah, that's fair. Yeah. Yeah, we've seen quite a few contracts recently where we have seen some seller concessions. We've seen some longer contingency periods, but again, those things are going to go away or they're going to get reduced. It's going to make it even harder for buyers if we get back into a market where we've got multiple offers on the table for most properties or any given property.
And I think the inventory problem is going to be a continuous problem. I mean, we've been dealing with this ever since the Great Recession. Mm-hmm. And I think we're going to continue to have that because like with that problem that we had or that time in the market, there were home builders that never came back. There were skilled tradesmen that never came back to the same industry. we took probably a 5 to 6 year hiatus of any building whatsoever because nobody wanted to touch paying for a new construction because there were so many empty homes just sitting on the market.
Right. Yeah,
and then, so once we finally caught up with that inventory, and then they do start building again, now we're behind the 8 ball with being able to keep up with population increase and just the growth overall. So I think, honestly, I don't remember where I saw it. I think it was we have a 4 to 6 year time period with constant building to be able to actually catch up with our inventory problem. And I don't think that we'll ever be able to chase. Like, we'll always be chasing that.
I think
because people are so scared of having a surplus of inventory that we're going to be back in a similar situation to where if something does happen to the economy, boom, now all these people are just sitting on tons of inventory. Banks, they're not in the business of owning homes, they're in the business of lending money.
Right.
So they didn't want all that inventory.
Yeah, I mean, that was, the whole business has changed since the Great Recession, since '08, and that's not going to change back. It's not going to go back to the way it was before for many reasons. It could be because the builder, doesn't want to take on the risk of having that many homes available and sitting. It's because banks don't want to lend that much money at one particular time. The builders we work with, they're usually doing 2 to 3 at a time, and that's it. So, what we can hope for on the inventory side is if rates do get back to a level where, I don't know what that number looks like, where, people who are locked in at, 3%, 3.5%, 2%, whatever, where most people are right now after refining in the COVID period, that they are going to be more comfortable to go ahead and say, all right, we're going to sell this house, we're going to buy a new house. We'll take a little bit of a higher rate, maybe like 3.5 to 5, something like that. That could create some more inventory. But I don't see anything else doing it.
I think it would be interesting, and certainly drop comments below, like, what is that rate? Everybody's been saying we're going to wait till the rates come. Like, what does that mean? Like, what does that mean?
Yeah.
Are we talking 5? Are we talking, like, what is that? I would just love to do. I love to ask people this question, because if it's a mythical rate, then we're never going to get there.
Well, I'm going to throw something back at you, is that most folks would probably, you can go online and look at a calculator, but they may not know what that rate is, but they know what that payment's going to be.
Yeah.
Right? They know what that payment increase would look like. So what is that payment increase where you're, because there's so many folks out there right now, I guarantee you, that are wanting to move. They want to do something different. They want to be out of the location, whatever reason, but it's, they don't want to give up that payment. So what is it going to, and that's great information. That would be good to know from our folks that are watching it.
Well, historically, and I'm sure you guys are aware of this too, like over the last, I think it's 30 or 50 years, anything between a 5 and a 7% interest rate has been a pretty healthy market for the most part. Sure. I think it was for 15 plus years, we were above a 7% interest rate.
Yeah.
During that time period. So, that's pretty fascinating, but you also have to take into account that the home affordability part of the equation was definitely not where it is today as it was then. But if you subtract out the inflation, it was pretty much right at the same spot. So it's kind of unique. I always like to look at it as the home prices that we were looking at like 10 years ago. During that time period, we're like, man, these prices are ridiculous. Like, I can't believe I'm about to pay X amount for this house. And so I always try to look at all of the real estate pricing and what's going on in the market through that frame or through that lens in today's market of like, hey, these prices might be astronomically high in our opinion currently, but what's it going to be 5 or 10 years from now? Are we going to look back and say, those prices were cheap in comparison to where we're at now, so I should have bought everything that I possibly could have?
So Fannie Mae did a survey with the top economists, housing economists across the country. I think they picked 10 or 15 of them, and they asked them to project what appreciation rates would look like in 5 years. The median of those economists, so the middle, so you got people that are above this, people that are below this, the median was 25% in 5 years. So if I told you that you buy this house today, in 5 years from now, your house will be worth 25% more, what would you think about that?
Yeah, I'm going to buy that house.
Yeah, right? Right. Exactly. So it goes back to real estate is a great wealth builder.
And I think it's going to come down to the two things of, one, the rate is really irrelevant. It comes down to pricing.
Sure.
How much what's my cash outlay every month? And is that palatable? A lot of people can't do that. And so if that's the case, then for one, they're going to be renters, or two, they're going to stay where they're at. So that's going to be the big hurdle. And I always, this is kind of off the subject of finance and real estate. It's, you always need to focus on trying to level up your individual earned income as much as you possibly can. And then once you get that high, then allocate that over into passive income. But that's for another podcast. So one of the curveballs I want to give you guys today, and this is a common talking point for us on the real estate side. I'm curious what your opinions are, or if you've heard any kind of murmurings throughout the industry. So the big commission lawsuit with real estate. So for those that may or may not have heard the whole thing, I'm not going to go into a massive diatribe on this, but essentially there were some lawsuits that took place where they felt that both buyers and sellers were harmed in the process of us representing them for having a seller pay the commission to the buying agent. Now in the past, the way that has worked, for me representing a seller, I negotiate that commission up front. And part of that conversation in the past, and still to this day, has always been, so this is the commission that I will do this deal for. There's no set commission rate ever. And it does differ between residential and commercial real estate, by the way. But through that process, I tell the seller, I say, hey, so the higher the commission, I'm planning on sharing a portion of my commission with a co-oping agent if they bring a ready, willing, and able buyer to the table. That's incentive, because now we have this network in MLS, multiple listing system, where we showcase and broadcast your property that's for sale. And then another agent brings their buyer that's ready to buy that house. And when you close that deal, that commission then gets split with the other agent. So essentially the result of this has been they no longer want sellers no longer want to have to pay or provide that commission to buyers. So that brings up a lot of questions, because there's going to be some buyers that don't have the means or the ability, if we're already in a housing affordability crisis, if you will, that now I have to outlay X number of dollars to be able to pay my agent. Mm-hmm. So you're going to have either unrepresented buyers, in my opinion, or you're going to have underrepresented buyers, because then the listing agent is going to be helping them or assisting them through the transaction, but that listing agent is not able to simultaneously represent both parties as clients, because that's a conflict of interest. So you can't advise two different parties in the same transaction, because you're basically working one against the other, if that makes sense. So now you're going to have somebody that's representing a seller and just assisting with the paperwork on the other side. So one of the common questions that I get all the time is, so with all of this going down, do you guys foresee, or have you heard about potentially being able to roll over commissions into a loan?
I mean, I had that question come up a few months ago, and I think it's still too early in that process. We still have some stuff going on. It'll be a little while, a couple of years at least, before it gets worked out, and the market's going to figure it out. Whether or not. Let me back it up. So in order for that to work, for the buyer to be able to roll in commissions into the loan, there's going to have to be changes on the agency side. So Fannie, Freddie, HUD, they're going to have to allow for that. Will they? I mean, I don't know. Who knows? It's going to be based on who's in the office at the time. What does it look like in the housing market at the time? I do agree with you. I mean, buyers. I don't see that the majority of buyers are going to be able to afford to pay buyer's agent fees or commissions, but something will happen. I mean, there will be the market's going to figure it out, just like it always has. Yeah. It's so crazy, because you hear the stories of, okay, well, now your buyers are going to be unrepresented, to it's just going to be some tweaks in the paperwork, and who knows what that's going to look like. That's and study this more than we do. But as far as from the loan side of things, there has not been any discussion that I'm aware of that is coming to the table that the agencies are going to allow the financing of the buyers' agents' commissions.
It's just so new.
Yeah.
It's just so new.
Well, it's very fresh.
Yeah.
I mean, we have, I don't know how it is on the mortgage industry side, but on the real estate side, agent side, we have an 87% failure rate year one. And then after that year one, if you survive year one, the drop-off rate by year 5, I think, is another 50%. So, I mean, our churn rate within our industry, as far as receiving new agents, is pretty high on a regular basis. And that's prior to adding any complexities into the market.
Right.
And so now with this, I have personally seen and heard there's a lot of agents that are leaving the industry. in my opinion, I don't have an issue with that because then that allows for more market share for,
cream rise at the top.
Absolutely.
Yeah.
So I think it is going to be about 2 years before we actually see any kind of big changes, whether it's in legislation, license law, or anything like that. We've already seen some contract changes as of 2024, both on commercial contracts and residential, where essentially it outlays, here in Georgia at least, I can't speak for other states, although I am licensed in South Carolina, I haven't seen those changes yet. There is new sections that we just covered, like for our team specifically on the commercial contract side, talking about what does the seller allow to be paid to the buyer broker.
Yeah.
And so now we're essentially in writing having that conversation when previously it should have already been a conversation. It just wasn't necessarily documented in that regard.
Right. And I just thought of something too so let's say you wanted to have the seller ultimately pay for the buyer's agent's commission, which is what's happening right now. In their own way, you would have, let's say you just had it where the seller puts it as a closing cost credit. It's customary for the closing cost to be this 3% of the transaction. The agencies would have to increase their interested party contribution limits to make that happen, but that's an easy change. So I can see that being something that is a fix. So I think there may be, it could be really big, it could be like a really big change in the industry, or it could be something that's, relatively small.
Now we just have to sidestep it.
Correct.
One of the other things on that same topic that I've seen, or at least had discussion about, is so we'll just say round numbers. If a property is worth $500,000 and they're not paying or contributing any commissions towards the buying agent, then it's okay, we will offer 3% above list price and then request that back in closing cost concessions.
Right.
Now, the problem that you're going to run into, especially as the market gets tighter, or depending on the property type, is then you have the potential of running into appraisal issues.
Yeah.
And then so if you have an appraisal that comes back low, now the buyer, unfortunately, still has to come out of pocket to make up for that.
Yeah, but it's still 6 one hand, half dozen the other as to where it is right now. So it's 5% or so $500,000, so 3% in closing costs, 3% to the listing agent. Whereas right now it's $500,000, 6% to the listing agent, which is then gets given to the buyer's agent. So it's the same. It's just moving the money around. Yeah. So we'll see. It'll be interesting to see.
Yeah. Other than that, any final predictions with the crystal ball as far as what we're going to potentially see when we come back in July?
I think when we come back in July, we're going to be in a busy spot.
Yeah.
I feel like this year is going to be much busier, and there's going to be many more transactions done this year than there were last year. Coming into the year, there's more certainty as to what's happening in the secondary markets. And although we're in an election year, I think with that certainty being given and then the test case of 2023, it's off to the races in 24. That's my prediction.
Cautiously optimistic. I think with it being an election year in the environment that we're dealing with right now, I think it's pretty unprecedented what's going on with our governmental, with the people that are running for president. This has never happened before, right? But I'm optimistic because we are seeing all the economic factors that we've been looking for a year and a half. They are moving in the direction we want it to, right? So I think the fact that multi-unit has now changed to a 5% down. If you're purchasing a multi-unit, we can go conventional with that. That's a big difference maker for first-time home buyers. They can possibly get into a multi-unit, have some rental properties, and actually offset their payment. So I think there are things that are allowing us to even move forward, even in the cautiously optimistic realm, just because I've been a terrible fortune teller over the last 18 months. So it's been hard.
Well, that's why I like to do these, because it gives us an opportunity to see kind of what's going on in the market now. Look back at previous historical data on 6 months ago, the last video that we shot in August of what our predictions were then, and to see if they align. Because really, it's just educated guessing at this point.
Right.
The best thing that we can do is always just try to serve our clients to the best capacity in each opportunity that we get. So other than that, guys, I appreciate it. I always love sitting down with y'all. And I definitely look forward to our next meeting in 6 months in July to see where we're at. My personal prediction is that we're going to see an absolute takeoff, especially with rates continuing to come down. There's going to be multiple buyer activities per property as far as the offers go, which is essentially just going to drive up home prices. Hopefully that doesn't price people out of the market too much. But it should be a good year, and as long as we continue to see some new construction happen, I think we'll start moving in the right direction. But I always say, if you could buy it, buy it. If you could buy two of them, buy two of them. So I will always stick with that sentiment. But other than that, I hope you guys enjoyed. Jake Blickenstaff with the Northeast Georgia Real Estate Podcast. Thank you, gentlemen.
Thanks, Jake. Appreciate it, man.
Enjoyed it, brother.
See you guys on the next one. Hey, everybody. As we wrap up another episode of the Northeast Georgia Real Estate Podcast, I want to extend a big thank you to our phenomenal guests, Evan Nissley and Ryan Liebowitz with PrimeLending. These guys are phenomenal to sit down with because they're just such a wealth of information when it comes to the financial markets and mortgage rates, and really having a thorough understanding of what's going on why mortgage rates are doing what they're doing, other than just looking at a number. But to all you property owners out there, whether you're considering buying, selling, leasing commercial or residential real estate in the greater Atlanta, Northeast Georgia area, or even the western upstate portion of South Carolina, remember that we are here to support you. Our dedicated team is ready to guide you through every step of your real estate journey and make it painless. Our team's an absolute powerhouse, featuring specialized commercial agents who excel in both leasing and sales across diverse categories, including office, retail space, industrial properties, and multifamily residences. On the residential side, our agents specialize in everything from traditional single-family homes to luxury estates, and even navigating the intricate world of REOs and short sales. And here's something exciting for all you licensed agents out across the Southeast, covering South Carolina, Georgia, and Florida. If you are seeking a supportive community of real estate professionals who can not only act as your mentors, but advisors, coaches, and essentially friends, then look no further. Here at VPR First Team, we provide exclusive one-on-one access to some of the most successful commercial and residential realtors and brokers in the field. So if you're looking for a new home, a place to learn, grow, and thrive in your real estate career, or if you're just on the hunt, don't hesitate to reach out to us. We're here to make your journey a smooth one as well. So thank you for joining me on another episode of the Northeast Georgia Real Estate Podcast. If you've enjoyed the insights shared today, remember to subscribe, rate, leave us a comment, leave us a review. But until next time, keep those dreams alive, and catch you on the next episode.